All right, Yield Nerds, episode 127. I thought I would release my own Magnificent Seven, except it's the Magnificent Seven stocks of healthcare. Well, let's get going. I am very excited to say we now have 349 subscribers. Thank you for your support. We're getting about the year and a half mark in terms of launching this channel. If you're new, I would suggest you start with the playlist called the Income Investing Roadmap. And finally, remember, I do not have any magical powers. You need to check and do your own decision making. I'm here to share my education. Today's episode has four agenda items. One, we'll go check the market temperature. And because we have a healthcare team, I figured, we'll go with the theme and do a lot of healthcare discussions today. We're going to also step back and look at what the defensive sectors are. And then we're going to dig deeper into the magnificent seven of healthcare. I'll talk about the filter I've set up, and I'll review my trades. Well, how has my wonderful portfolio done in the last 90 days? My portfolio has certainly done better than the fixed income, traditional portfolio. Having said that, I will say, my portfolio has paled in comparison to the Nasdaq and the S&P. So something to learn for me. I'm going to start figuring out what else I can do as long as they are measured risks. At the end of the day, I would tell you that my humble opinion is if 70% of the S&P gains are from two stocks, I don't know that that is really a market anymore. That is my feeling. You do you. As far as my investment philosophy itself, those of you who have been there, done that before, know that I am very much into fixed income. Barely 0.5% of my allocation, a month and a half ago was in equities. I am accelerating, and as I see some consternation in the market, I am buying more equities, but it still is a very, very small amount of my portfolio. The bulk of my portfolio is still in short-term treasuries. I do believe, whichever way the election goes, the yield is going to increase, and there may or may not be an equity event. So I'm positioning towards higher yields, higher interest rates later in the year, or an equity crash and lower interest rates, in which case I'll jump to equities. So that is my strategy. You do you. I have some agency bonds, some of them got called, and I have some corporate bonds that I'm trying to get rid of. So let's talk about defensive sectors. What is a defensive sector? And generally, I'm about to review specific equities. I want to make sure I again reiterate I am not a wealth management advisor. What you are seeing is not investment advice or tax advice, and I don't do product and politics. You take care of that yourself. My thesis is that we are headed into, some level of turbulence. And despite the amazing performance of the S&P and Nasdaq compared to a fixed income portfolio like mine, I do think jumping into equities with the fear of missing out would be the wrong call for me. You do you. And without fundamentals, just signing up to hype and growth stocks is just not the way I think. And therefore, I look for defensive stocks. Look at that wonderful man getting his health checked up right in front of the New York Stock Exchange. He has no choice. Whether it is a good economy, bad economy, you still need healthcare. And as long as the fundamentals of a healthcare institution is good, then in general, that should do well. And so the way I think about it is what are sectors that will do well whether or not the economy is doing well? And if they have good fundamentals, then I'd like to own them. The common idea of a defensive sector is food. In good times and bad times, we're going to have to eat. We're going to have to turn on the lights. The military is not something you can skimp on. During recessions, the government does tend to spend less on the military. But unfortunately, there's a lot of global conflict going on. And therefore, I humbly believe our military spending is going to increase, not decrease. Healthcare is another one where, we don't have a choice in terms of postponing very needed care. So depending on what kind of healthcare entities they are, there is some opportunity to invest there. And, there are tech companies that also service these same defensive industries. And so we'll talk more about that. I do own a couple of equities in that area. So long story short, I'm going to start diving deeper into healthcare. What are healthcare sectors? What are healthcare companies? that will win whether or not the market goes up or down. Look at that young healthcare provider making buckets of money servicing people in good and bad times in the economy. That's what we're trying to dig deeper into. And here comes the magnificent seven of healthcare. Now, what do I mean by that? I'm going to set up a filter, and the filter is generally going to start looking at, I know healthcare in general has very high fixed costs. You build this huge hospital tower, or you build this, corner clinic, and you pay rent for the next 30 years. You're in a lease. However, once you meet the fixed costs, the variable margin, the contribution margin, as it is called, is very, very high. In other words, the 101st patient only costs electricity for the physician practice, and their billing is pure profit. And having said that, profitability is evasive in healthcare. I know that. I started a company that serviced healthcare technology. There is a lot of competition. There is a huge amount of regulatory burden, and then there is always the hacking fears and privacy fears. So, is there a Cinderella in this industry? And that's what we're going to start looking at. And let me review the filter here, which I call the Magnificent Seven Healthcare. The first we're going to do is make sure there is high trading volume. High trading volume means low spread, and so I look for that. I do want profitable companies with good cash flow, and I don't want to pay a huge PE multiplier, especially in the defensive sector. And here it is, I'm only looking at healthcare and price to cash flow. Now, what is that? For every dollar of operating cash flow that is generated, how many dollars are you willing to pay upfront? And in some of the tech sectors, this number is insanely high. I'm limiting it to a low number. And, I only buy domestic companies. That's just my philosophy. You do you. And I'm looking for companies with 50 million or more in market cap. And I would like for their revenue to be on an increasing trajectory, not a decreasing trajectory. So with that, I say, okay, now tell me more. Who meets this criteria? And here comes the Magnificent Seven of healthcare. Turns out there indeed are only seven companies in healthcare that meet that filter. HCA, which is a large hospital system, Collegium, which makes a certain kind of medication, Universal Health Systems, which is a behavioral health organization. They own many, many behavioral health hospitals around the country, the largest in the United States. Tenet Healthcare, also a health system. DaVita, which is in the dialysis side. Organon, which is in women's health. And AMN Healthcare, which does staffing for nurses, among several other things. Couple of quick things. We're going to eliminate companies before we go deeper. The first, sorry, AMN, nursing labor was in a rocket ship during COVID. Nurses used to make a lot of money, good for them. But that has kind of solidified. Hospitals now employ nurses. They don't do too many of these contract nurses paying premium prices. And AMN's revenue tells the story. Both in the fiscal year basis and trailing 12-month basis, it is coming down. So I am not going to dig deeper into AMN. And the next thing is Organon. Organon had a good run, but their growth has dramatically slowed down. And so again, if I'm looking at where is the company that is positioned for growth and also at a low price, that doesn't fit the bill. DaVita has two problems. Their growth is okay. 6%, 7% is not too bad, but their PE ratio is 16. And in the healthcare side, that higher PE ratio for a low growth, it's hard for me to kind of get excited about it. There is another one that I'm going to eliminate, even though UHS is a fantastic company. Their profit margin is very low, 5%, and their PE ratio is very high. And you put those two deadly combinations, if the administration, if the government decreases prices by 5%, that's all they need to do, this company would start making losses. Even though it's an amazing company, I just can't see myself paying a really high PE ratio for them. So once I eliminate those, I'm left with three companies. Look at that, Collegium. We'll dig deeper into them. Collegium growing at 22%. I like that. That's what I was expecting. And I'm also excited by HCA, for a large hospital corporation to grow by almost 10% is unheard of. And that's amazing to me. The next thing I want to look at is Tenet Healthcare. Look at that P/E ratio, 5. One of my favorite all-time stocks, TK Tankers, trades at a PE ratio of 5. So if you have a company that is growing, that is profitable, trading at a low PE ratio, talk to me. I want to get to know them. So these are the three companies we're going to dive deeper into. Let's go into Collegium. And the moment you look at Collegium's revenue, it kind of I have my reservations. They certainly had a Cinderella story from 2001 where their revenues kept going up, 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 and it looks like it has flatlined for many, many quarters. And so the other side of all of this is there was a Supreme Court case recently about OxyContin, Purdue Pharma, and this Collegium makes the new kind of OxyContin, the slow release OxyContin. And so it's hard for me to see if they've reached their market peak or not. And so given that growth is no longer accelerating, I kind of am going to put them in the back burner. We do have to pay a high P/E ratio for them, but I'd like to see that growth increase before I go there. Um, then we look at two that are left, HCA and Tenet Healthcare, and just looking at how their stocks have performed, some kind of magic seems to be happening at Tenet Healthcare in the last 12 months. And you go, well, the stock is going nuts. Let's hope that the fundamentals back it up. And so we're going to dig deeper into both of them. And the first thing I'm going to do is compare the two of them, and I'm almost choking here. What? Tenet Healthcare has a long-term debt-to-equity ratio of 369. HCA shows as though they have no debt, and that is not true. They have debt to capital instead of debt to equity. We'll talk more about that. But at the end of the day, they both have the same return on assets and practically the same return on investment. However, one finances using equity and the other finances using capital, and there are two different ways to finance. But what is interesting to me is Tenet has a profit margin that is huge, 16%, and HCA is only 9%. So far, with just those two limited data points, I'm liking Tenet, but it gets better. Once you start looking into valuation, Tenet just takes the crown across the board. Tenet's PE ratio is a third of what HCA is. Tenet's price to sales, meaning if you took the annual sales of Tenet, you could buy the company, the market cap, with just 60% of the annual sales, which is insane. Price to cash flow is also very reasonable. Price to earnings growth, assuming they hit their earnings target, this would indicate there is still room for the stock to appreciate. And then you look at annual growth. Whoa, 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 what is happening here? The earnings per share, magical things are happening for Tenet, and it is also forecast to continue growing. And you go, what is going on at Tenet that they are able to do this? And are they, doing it the right way? That's what we're going to look at. Um, I would say the verdict is pretty clear here. If I have to pick between the two, I'm going to pick the company with the lower PE ratio, with higher operating margin, higher net margin, higher cash flow per share. Tenet is just hitting the ball out of the park, and their stock price is being rewarded for it. And here comes the answer. HCA has debt to capital, which means they have pledged a lot of their fixed investments, and Tenet has debt to equity, and they both are very much in debt. So unless you have reason to believe they're going to be able to pay off their debt, both of them have danger. And so we're going to start understanding Tenet. And so I started going into their 10Q. The first thing to know is that Tenet owns 52 hospitals in 9 different states, so they're a pretty large company. They have 150-ish outpatient facilities, and they also own this company called Conifer Health, which they originally started as a joint venture, and then they acquired it fully, and that does billing and additional support activities. But there is also another joint venture which became a fully owned subsidiary, which is hitting it out of the park for them, and that is USPI. USPI is their ambulatory surgical center side of the house, and they have 500 of these. And they have 25 just surgery hospitals, and these are diversifications that do very well for a large health system, because procedures cost $20,000, $30,000 to do at the big hospital. They cost $6,000, $7,000, $3,000 to do at an ambulatory surgical center. Insurance companies are pushing volume away from the hospital to the ASC, and it looks like Tenet is at the right place at the right time. That is where the magic appears to be happening. And sure enough, the management strategy supports that. They are saying we are going to expand our ambulatory care and USPI, and we're going to keep buying more and more ASCs, and we're going to start selling hospitals that are not profitable. And so they are getting out of one business, getting into the growth market, and it shows. They sold 9 hospitals. They started at 61 hospitals, ended at 52. And you sit there and go, ooh, that's 15% of the hospitals that they sold. So their revenue should probably decrease by 15%. That's what you would think. But look at what happens. Their paying admissions goes up and not down. And you have to rub your eyes and go, wait, they sold 15% of their revenue producing assets, but their revenue went up. How is that? Well, the answer is they sold the ones that weren't doing well. They invested more in things that do well, and that is producing dividends across the board. They have more admissions, they have more ED visits, and this is a Cinderella story, nothing short of it. If you know healthcare at all, to think that your ED visits would go up by 5% when your number of hospitals go down by 15% is just magic. And their length of stay is going down, which means their costs are going down, and they have more beds occupied on any given day than before. So in every single metric, Tenet is screaming now compared to a year ago, and that is the reason why their stock price is being rewarded. So definitely under the surface, Tenet is doing a lot of the right things. And you can see that they sold 9 hospitals and they built 67 ambulatory facilities. And so they are investing in things that produce money. And here's the other cool thing they are doing. They are taking the profits and keeping some of the debt that's at 7%, that's due 7, 8 years later, but paying off some of the debt that is coming due right away. And whether you can argue, hey, why aren't they paying the higher interest debt versus the lower interest debt? It looks like they paid off close to $2 billion in debt. And the reason they are doing that is because operating cash flow is enabling them to be more profitable, pay off debt that is coming due in short order. I would love to see management pay off some of the higher interest payment debt, but sometimes you may not have the opportunity to even repay it before a couple of years. And so this company is decreasing their leverage while they are increasing their revenue and increasing their profit. Just absolutely phenomenal performance here. Everything else is kept the same. You know, they're keeping the longer term debt right there. Their finance and lease obligations are going down because when you sell a hospital, you sell the lease along with it. And so their long-term debt is actually coming down. And so if you make more profit and you make more revenue and you have less debt, your balance sheet and your income statement look amazing. And that is what they are showing. Revenues going up, gains on sale of hospitals, net income going up by 1,000%. That's insane to do in healthcare. And earnings per share going up by 2,000%. And so there is something real happening here. Let's just hope they can continue. This is too much of magic here. And if they are able to continue this, it would really make a big difference. You can see that the total diluted shares actually went down. So they are using some money to pay off debt, other money to buy back shares. And so they really are going gangbusters. So when I saw that, here's what I did. Yes, I bought Tenet Healthcare. I'm excited, and I hope the Cinderella story continues. Based on some of the previous episodes, I bought more Evolve, Applied Materials, Huntington Ingalls, and of course, I buy a bunch of treasuries. And I'm sad to say some of my agency bonds that were paying 6% state tax free were called. Life happens. And so here are my holdings. And my very first healthcare stock, Tenet Healthcare, is now on the books. I have a whole bunch of energy, a defensive stock. I have Cal-Maine Foods. I do have a couple of tech stocks that service the military. And, in general, every single thing I own is on the defensive side of the house. And so far, my portfolio is up 2%, which I'm happy about. So make sure you make your own decisions. And thank you for watching YieldNerd.